Good morning. My name is Neves, and this is my thesis presentation, Optimizing Financial Portfolios Through Time, a Comprehensive Machine Learning Approach. I will start by giving some context on the subject in the introduction, then talk about the literature review and methodology, and end with the obtained results and final conclusions. So until 2017, the area of finance has been relatively immune to machine learning technology, with a few exceptions such as high-frequency trading and credit scoring. And since then, machine learning and deep learning made their way into many disciplines, such as the financial markets, where a lot of money can be lost due to market and portfolio risk exposure. So as you know, the accurate market prediction is extremely challenging, as financial markets are highly noisy and of chaotic nature. And as a result, there was a shift from statistical, more traditional techniques towards more robust algorithms that can navigate volatile markets. So investors and market participants need to optimally allocate limited funds in a variety of potential assets and in a periodic manner to establish risk control. And so the goal of the thesis is to further investigate into this portfolio management problem in order to enhance asset allocation decisions. Moving on to the literature review. So the asset allocation optimization problems is not as rich in literature as some other fields within data science for finance, such as price forecasting, for example. Nevertheless, 84 studies were included in the review, using keywords going from broader terms like financial risk and data science to the most narrow, such as portfolio optimization and reinforcement learning. Regarding the metrics, most publications used were journal articles, mainly from the year 2020 to 2024. And in terms of geographic distribution, China, USA were the countries with most publications, followed by United Kingdom, Canada, India, and other European countries. So regarding the content is very straightforward. The literature review starts by analyzing the different types of risk in the context of financial risk management and machine learning applications, and then the most seen and utilized portfolio optimization techniques, as well as their evaluation metrics. And the literature review ends with research gap analysis, where the 8 most similar studies to this one are compared in terms of the optimization techniques, the origin of portfolio construction, the evaluation metrics, and ultimately this research gap analysis is what's going to lead to the present design of the study, as you can see in the tables. Yes. Okay, moving on to the methodology. So this is the overall description of the study built from the conclusions of the research gaps. 5 optimization techniques were selected, 3 more traditional and 2 more recent. So this selection aims at representing different approaches through time. Also 5 evaluation metrics that aim to represent different angles of portfolio performance and that identify different advantages and disadvantages of the different techniques. In terms of assets used were stocks from the PSI index, so the biggest publicly traded Portuguese companies. For the benchmarks, the 1/n portfolio, which is a portfolio where all assets have equal weights, and also the performance of the PSI index itself. In terms of data, it was extracted from Refinitive's icon using Nova MS license, and the technical analysis data was transformed using Python, also from Refinitive's icon. So regarding the selected techniques that I used, the minimum variance portfolio allocates the weights of the assets with the purpose of minimizing variance of the overall portfolio. The inverse volatility portfolio assigns a weight to each asset that is inversely proportional to its volatility, therefore creating a concentration in low volatility assets. The maximum diversification portfolio aims at creating the highest possible degree of diversification by maximizing the diversification ratio that you can see. And then we have the more recent ones, such as the HRP, which is a modern optimization technique that takes into account the hierarchical structure of asset classes and their correlations and risk contributions. And it has essentially 3 main steps. The first one is clustering the assets with similar time series in an agglomerative way. The second step is called quasi-diagonalization, where the covariance matrix will be rearranged so that similar assets are grouped together and dissimilar assets are kept fairly apart based on the clusters that were formed. And the last one is recursive bisection, where the weights are distributed by recursively bisecting the rearranged covariance matrix from the previous stage. Lastly, we have PPO, which is a policy-based algorithm that belongs to the family of policy gradient methods. PPO was developed by OpenAI and addresses some of the limitations associated with traditional policy gradient approaches, namely the magnitude of the policy updates. And below this cycle here is the application of PPO in the actor-critic framework, which was how it was applied in the study. Where the policy and advantage estimates are being updated at each iteration. And I will explain this architecture a bit more in detail in a few slides. So regarding the selected evaluation metrics, we have compound annual growth rate, which is a measure used in finance to express the average rate of return on an investment per year and taking into account the compound returns. We also have Sharpe ratio that helps investors assess the performance of an investment by taking into account the risk-adjusted returns. So it's a measure of excess return per unit of risk. We also have expected shortfall, also known as conditional value at risk, provides the expected value of the losses that occur beyond value at risk threshold. So for example, if a value at risk is 1 million, the expected shortfall will provide average of losses that exceed 1 million. So maximum drawdown is the largest drawdown that a portfolio or an investment experiences over a specified time period. And lastly, Kalmar ratio, similar to Sharpe ratio, provides a way to assess how well an investment or strategy has performed relatively to the level of risk. It can be defined by dividing the annual return by the maximum drawdown. So regarding data transformations, all the data was treated independently according to their category and later merged, as you can see on the left, the different categories. So index data, macroeconomic data, company financials, price history, and technical analysis data. And on the right, some of the data transformation decisions undertaken. So the data was sliced to be from 2014 to 2023, and two companies were excluded, namely Green Vaults, which only entered the index in 2017, and Ibersol, which has left the index and joined back, so there was a lot of data missing. I also removed stock market holidays, since these are not relevant to identify patterns in data. And I used backward fill method for slowly changing variables, mostly for macroeconomic data, where the data changes once a month or once every 3 months. Also used linear regression to infer 2023 in company financials. Since these metrics are expected to linearly change from one year to the other, and there was no other 2023 financial data for a more suitable imputation method. Also used these core box plot techniques to remove outliers. And this was done in a very, very conservative way, not to lose patterns. So other techniques such as IQR and DB-scan were also attempted, but did not perform well. And lastly, KNN inputter with robust scaling was used to fill leftover missing values that represent a very small percentage of the data. So some other considerations. The rebalance period was 21 trading days, so portfolios would be rebalanced sensibly once a month. Then the window length of available data for training was 42 days. The constraints are that the weights must sum to 100%. No asset can have more than 100% weights. No negative weights. And the data was split 2014 to 2022 train and 2023 test. In the end, there were two final data sets. So one for traditional modeling, where there are the inputs are the closing prices or the covariance matrix of the closing prices, depending on the case. And for the PPO modeling, includes all the pre-processed data with 147 variables, so 5 price history variables, 2 financial variables, 3 TA variables for each of the 14 companies, plus 2 economic variables and 5 index variables. It's quite big. And this data set was further pre-processed to facilitate the tensor creation. So instead of having repeated features for different assets, the data was pivoted in a way that the index dates would repeat for each of the assets, and an asset column was used to differentiate the different features. As you can see, it's the column code. And afterwards, this data goes into a preprocessing pipeline developed with scikit-learn that sequentially splits the data into train and test, calls the log transform class that applies logarithmic transformation to each column, and dynamic clip transformer class that limits the values in each column to a specific quantile range. So the normalization parameters are also safe to be later applied to the test data normalization along with the same transformations in order not to cause data leakage. And this is the PPO actor critic architecture in the way that it was used. So the environment simulates the trading environment, the actual trading environment, initializes the variables, receives the data as input, and continuously outputs state and price history tensors. Then the agent contains an actor and a critic, which are essentially two networks comprising the PPO in the actor critic form, so two models. The actor determines the actions to take given the state and price history tensors. Then the critic will evaluate the actions taken by the actor. There's also a portfolio manager wrapper that keeps the whole process going. It initializes the agent and the environment, iterating the process through the trading days for all the epochs, and records the performance of the agent over time and calculates the financial metrics. And throughout the process, the parameters of both actor and the critic networks are updated as the networks learn and make better predictions. Moving on to the results. So for minimum variance, the allocation had a prevalence of for REN across the whole period with a good SMAPA representation after the June rebounds. Corticera Amorim also has significant weight in the portfolio mainly until May and after October, whereas Navigator was more prevalent in January and after April. Inverse volatility was the optimization that provided the closest to an equally balanced portfolio with a smaller predominance of REN. All assets seem to have very similar weights across the period. Maximum diversification. For maximum diversification, the allocation had a prevalence for REN across the whole period with a good Jerónimo Martins and Galp representation. Altri had a significant weight in the portfolio, mainly until August and after October. And lastly, the HRP also shows a relatively balanced portfolio with a prevalence of NOS, REN, SONAI, and Corticera Amorim. So this is just the allocation. Now, conversely to other strategies, for the PPO actor critic methods, it seems like Altri and BCP were extremely predominant. It's very different than the others. So upon analyzing portfolios from different epochs in the training phase of PPO, it is possible to see that as the epoch number increases, PPO tends to build more concentrated portfolios, being very conservative in the way that it decides to add new assets. So in terms of metric comparisons, so this is the return measure. PPO and PSI index seem to outperform other strategies, with maximum diversification also being very predominant in some periods. The remaining strategies were not able to beat the benchmarks on average for this metric. As for risk-adjusted measures, for Sharpe ratio, PPO and maximum diversification were once again the best strategies. The remaining strategy did not beat the equal weight portfolio benchmark, even though they were able to beat the index. For Calma ratio, is the same situation, with the exception that the minimum variance strategy was also able to beat the benchmarks. For maximum drawdown, the PPO strategy was actually the one that performed the worst, and only maximum diversification and minimum variance were able to beat both benchmarks. As for expected shortfall, all strategies were able to beat both benchmarks, with the exception of PPO. And the best strategies for this metric were HRP and maximum diversification. So to summarize, the PPO strategy stands out with the highest returns, indicating the best performance in profitability. Furthermore, it showed exceptional performance relatively to its downside risk, with the highest Calma ratio and second best Sharpe ratio. Only PPO and maximum diversification strategies outperformed both benchmarks in overall terms. So PPO for the return and risk-adjusted metrics and maximum diversification across all metrics. HRP showed a lower risk of loss, but also poor returns in comparison to other strategies. Other traditional strategies highlight in different metrics, such as the lowest risk of significant loss. And essentially, this study contributes to portfolio optimization literature and helps market participants navigate noisy and volatile markets, raising awareness to different methods of building high-performing portfolios. Thank you for your time, and feel free to ask me questions. Thank you to my supervisor as well, in particular. And yep, that's it.
Thank you, Lucas.